Another data disaster, another government showdown. ADP says the US just lost 32,000 jobs back in September, and now the government shutdown is blocking us from getting Friday's official payroll numbers. Yet somehow Wall Street is dancing at record highs, and the Dow just closed its record ninth close. We've seen the S&P 500 hit its 29th record high of this year, and the Nasdaq added another gain today. So what's really driving this market, and how long can investors keep ignoring the cracks that are underneath our feet right now? Let's break it all down. So today's stocks surged, seeing pharmaceutical shares once again leading the way, leading this market higher. And this was the second straight session of pharma strength after President Trump unveiled that news on a direct-to-consumer drug website. And the idea is that Americans will buy drugs directly, while companies like Pfizer and Eli Lilly, they get this tariff exemption if they build plants here in the United States. And they're seeing a lot of optimism caked in around that, and possibly some shares that could be a little cheap considering this new news. We've seen the Dow close up 0.09%. That was its ninth record close. Like I said, the S&P 500 hit its 29th record high of this year, closing in at 0.34% in the green territory. The Nasdaq added 0.42% today. So today was a great start off to October, which we've covered a few videos back on, talking about how Q4 is usually the strongest quarter of the year, and then throw in on top of that, with it having a positive September before that being even more news to an even stronger possible Q4. Now, the past doesn't always repeat itself, and then there has been this talk around government shutdowns and how that could drive this buy the dip mentality. So that could just be what we've seen going into October, after September ended up being a phenomenal month for stocks. Now, behind the scenes, what we're seeing is that these ETFs, exchange traded funds, behind the scenes are quietly fueling this rally. So far this year, US listed ETFs have taken in a record shattering $917 billion in net inflows. Now, if this pace keeps up here in 2025, this will mark the second straight record for the ETF market, and it's really just two heavy funds doing all the lifting. We got Vanguard's S&P 500 ETF and BlackRock's iShares Core S&P 500 ETF. So the S&P 500 is a huge one, together with these two ETFs making up nearly 60% of those inflows. I think it was like 59 and some change. I rounded on some of the numbers, but that's really showing people are bullish in this stock market in the S&P 500, the top 500 companies. So keep on watching that. We'll see how that concludes as we head out into the end part of this year, heading into Q4. Like I said, we could possibly see some type of Santa Claus rally, but you never know with how uncertain things are these days. But there's this old Wall Street quote from Citigroup's former CEO Chuck Prince that's making its rounds out again. As long as the music is playing, you've got to get up and dance. And that's the saying that a lot of people are referring to kind of describe this current environment in the stock market right now, with what we're seeing with investors who know valuations are stretched. They are piling up on risks out of fear of missing out on more upside, and that's really weighing the fear of some type of correction down the road. But right now, things are going up. So Wall Street strategists from Deutsche Bank to Goldman to HSBC, Evercore, BMO, they all have hiked their year-end targets for this year. Some now seeing the S&P 500 closing at or above 7,000. And it's not just tech this time, it's industrials, utilities, healthcare. All of the 11 S&P sectors are green for the year, and that broadening is really fueling the optimism we're seeing. But with volatility this low, some analysts are even warning there's this complacency being this real risk. And I believe that's what Jamie Dimon warned earlier this year, and multiple times this year, that market complacency is something a lot of people should start thinking about with where we are right now in the current macro environment. Stocks have been doing phenomenal. You could have sold your stocks earlier this year and missed out on all types of gains. You could have sold at the bottom of the Liberation Day sell-off and completely sold at the bottom and bought at the top, just because this fear of missing out's beginning to kick in. And now the headlines are going from we're possibly heading into this recession to where I'm seeing a lot more articles on Wall Street Journal, Barron's, Market Watch, on CNBC. A lot of people are kind of dropping all of that. And, well, we got the Fed to look forward to. It looks like Trump's been phenomenal for stocks. It looks like these companies are earning growth. So it's not like these bubbles we've seen, like that .com crash, for example. AI is completely different. But complacency. What does that word even mean? But anyways, we got some data today, and this is where the story really gets messy, because we've been talking about stocks which have been doing pretty well. This is one of the main concerns for people who are worried out there to be worried. So it's the labor market, and we're watching data. Investors, economists, strategists, Fed members, they're all watching the labor market to see how well it's holding up, because the Fed has this dual mandate to control inflation and to keep sustainable job growth. They want to keep everything moving smoothly. And of course, what I said is not just word for word, but stable employment, their 2% inflation goal. So right now, the two risks that they're really facing is the risk of inflation going up, but they're also facing this other risk, which is the labor market going down. So that's why a lot of people's watching the labor market, and with interest rates being where they're at, a lot of people would likely blame the Fed for the economy's reckoning and whatnot. We've seen it all through history, but with the labor market being where it's at and it's starting to go down, we've seen those BLS revisions. A lot of people are watching the labor market now to see how well it's holding up, because, all right, what's that say about the economy? How are people paying their bills if there's all these people getting laid off? How's all of that going? And today, actually, before we get into this ADP report for private payrolls, Paycom, a company here locally where I'm at in Oklahoma City, has laid off 500 people due to trying to replace some of these roles with artificial intelligence. So we're seeing this happen in live. But let's get into this. So it gets pretty messy here. The ADP's payroll report dropped a bomb today. The U.S. lost 32,000 private sector jobs back in September. Economists had expected a gain of 45,000. So for that number to come in negative 32,000 when they were expecting this gain of 45,000, that's looking pretty bad. Like, that's not a good sign that things are just great out there in the economy. The leisure and hospitality space shed 19,000 jobs. Small businesses cut 40,000 jobs, while big corporations added jobs. We've seen the education and healthcare were the only real bright spots we've seen in this ADP report, and this is the weakest private sector reading all year. And remember, ADP has been catching labor weakness early before it shows up in the government's official data. Normally, we'd wait for Friday's data to come out, because and what's coming is the BLS jobs report to confirm. But what we got right now is this government that's shut down, and that release is now off of the calendar. And investors may be flying blind for the next few weeks without the key economic data that not even just investors are watching. The Federal Reserve members are watching it too, politicians. Everybody's watching this. So at 12 p.m. Wednesday, government funding lapsed. So today the government shut down officially. That means a few things, like no official jobs report on Friday. We just covered that. No inflation data in mid-October if the standoff drags on, and we don't know how long this could take. But a data blackout where investors rely on private reports and Fed surveys is now how you'd describe this environment now, because, all right, a lot of the stuff that's kind of depending on which way we go, that's now not available to us. So, that's uncertainty. So essential workers like TSA, air traffic control, Social Security, they're going to keep on working, but without pay until the government reopens. Now, this could be a couple days, could be a couple weeks. I think Trump's record was 35 days or something, and a lot of people are expecting this to end up being resolved in 14 days, and they're really lining the 2-week process because these people need the money to pay their bills. But what would that look like if now? I don't even want to talk about that. Then non-essential workers, what we're seeing with them, they're facing these furloughs, and Trump really even floated permanent layoffs. A lot of people are thinking Trump wanted this specifically for that furlough part. Historically, those shutdowns don't crush markets. Back talking about the stock market, we've seen the S&P rise in most of the histories that have these shutdowns, but this one comes at this delicate moment, right? We've got this weakening labor market, and we want to see how the data is coming up on it. But then the Fed cutting rates possibly this year is also something that a lot of people are going to be talking about. So after today's data, what we've seen is the Fed odds, and I've kind of watched around on them. So for October 29th, the expectations of a Fed cut now lie at 99.4% for a 25 basis point rate cut, or a 0.25% is another way to think about that. Now, the way this has moved after today's went on, because I checked before the ADP jobs release, I seen during and then after. So before the changes in the day, this 25 basis point cut, that was sitting at 99%. And then there's 1% of the Fed even dropping 50 basis points. Now, I'm curious as to why this possibly moved the way it is, but all we could really do is cover what we've read today. And I didn't read anything that really, other than stocks just powering higher. But if we're not getting that data, I don't understand why that would move this Fed watch tool the way that it's been being moved. I guess maybe in a way the Fed could argue not cutting rates because they haven't seen the data, potentially if they don't ever see this data somehow, or it's super delayed. So maybe from that perspective, but that's kind of concluding to this paradox that we're in, because on one hand the economy is flashing yellow lights. We got this ADP disaster, complete not good. I didn't want to say that other word where it's boom, but consumer confidence sliding, government paralysis, not really coming to an agreement from the inside, and how that really impacts the outside. And then on the other hand, we got stocks being pretty euphoric, record highs, massive ETF inflows, and analysts hiking their targets on the S&P. It's all really aligning with what we said earlier about that saying, that Chuck Prince line, you dance until the music stops. But the real question here that we got is, who's holding the DJ booth? Who's in front of that light switch ready to cut it off? Wall Street, the Fed, or is it even the economy itself? So while Washington stalls and job data disappoints, the market is currently shrugging it all off. It's not an issue, pushing higher. But the big risk is what happens when the data blackout ends, and whether investors like what they see.